As we know, the Fed finally cut rates by half a point, only to have absolutely nothing change in the housing market crisis. Granted, lower rates usually translates to lower mortgage interest rates, which will give buyers more buying power, and that's a good thing. But is it enough? We had some of the bigwigs saying that once rate hits 6%, home prices were going to go through the roof, which would counter any relief we're getting from interest rate cuts.
Is if rates go down just another percentage point, that's what I'm hoping for by year end, prices are going to go through the roof. And the reason for
that would be around 6%, get to that level.
Because everyone will come out and buy. There are probably 10 buyers on the sidelines waiting for interest rates to come down, because I wouldn't be surprised if real estate went up by another 8 or 10% if interest rates come down another full point.
Well, according to Freddie Mac, the 30-year weekly mortgage interest rate as of September 19th was 6.09%. And I don't see all those buyers hitting the street, causing home prices to spike another 8 to 10%. So I don't think we need to worry about that yet. But if it's not lowering rates that will make a difference in our housing market, what exactly will it take? So today, we're going to go through what the housing market really needs to make a difference. We'll touch on where mortgage rates are expected to go all the way into 2025, because that is an important piece of the puzzle. Rates going down is a good start, and we hope that trend will continue, but it's not enough. We'll take a look at Samantha Deloa's article for CNN titled, "America's Home Affordability Crisis Has a Solution. Lower rates, it isn't," as well as Moody's Analytics economist Nick Villa's analysis following the Fed cut titled, "America Needs More Affordable Housing, Not Just Class A Inventory," and we'll break it all down. So let's dive right in. Although mortgage rates have fallen considerably in recent weeks, we've not seen evidence of a corresponding increase in loan application activity, nor has there been an improvement in consumer home buying sentiment, wrote Doug Duncan, Fannie Mae's chief economist. Even Jerome Powell said he didn't think lowering rates would necessarily open up the housing market. The real issue with housing is that we have had, and are on track to continue to have, not enough housing. And this is not something the Fed can really fix. Ultimately, by getting inflation broadly down and rates normalized and getting the housing cycle normalized, that is the best thing we can do for householders. And the supply question will have to be dealt with by the markets and also by the government. Jerome Powell. Understood, the Fed can't make people sell their houses, although they can wildly manipulate the housing market by slashing interest rates like they did at the beginning of the pandemic, and then raising interest rates 2 years later when they were trying to fight inflation, but I digress. And until interest rates hit below 6%, or in my opinion, closer to 5%, the lock-in effect will continue to restrict inventory. Last year, existing home sales fell to their lowest level in nearly 3 decades. And NAR, the National Association of Realtors, just put out data showing existing home sales dropped 2.5% in August from the prior month and 4.2% from a year ago. The problem is, not only do we not have enough homes for sale, but increasingly rising home expenses such as homeowners insurance, property taxes, have made the cost of owning a home more and more unaffordable. No question, this is good news, said Sean Donovan, a former U.S. Secretary of Housing and Urban Development, told CNN of the Fed's rate cut. But there's a lot more we have to do to solve an unprecedented housing crisis in this country. Nick Villa, a Moody's economist, has said for months that a rate cut won't fix the housing crisis. In his opinion, we need more supply, and he is very specific about how that supply should be created. So while rate relief is one part of the equation, the other, more important part, in my opinion, is supply. Villa wrote in an analysis following the Fed cut. Naturally, increased home building comes to mind, but the type of properties that do get built should reflect varying price points and not just be concentrated on the upper end of the market. He goes on to explain that in the last 25 years, the share of Class A multifamily units rose 18%, making up slightly more than 50% of the multifamily sector. This includes upscale luxury apartments targeted at rich tenants. In other words, the share of Class B and Class C multifamily units has fallen by 18 percentage points, as developers have been prioritizing buildings that command higher rents, he explained. Elena Botros explains in her Fortune article that Class B apartments are older but considered well-maintained. Class C are decades old and sometimes charge below market rent. Both are needed because not all Americans can afford luxury apartments, let alone buy their own homes. Still, inventory growth for Class A multifamily units increased by nearly 19 percentage points since the end of 2019. Yet for Class B and Class C, units growth was just 2.6%, Villa said. Class A asking rents were 45.4% higher than Class B and Class C. So it makes sense that developers and builders would focus on these high-end buildings because they're going to make more money. He does add that another reason that builders and developers could be focusing on these high-end properties or Class A units could be due to the increase in the number of people who make more than $100,000. Based on data from the Census Bureau, the share of U.S. households that make more than $100,000 increased from 31.9% in the year 2000 to 37.5% in 2022. The bottom line, we need more of all types of housing, Class A, Class B, and Class C. Instead of drill baby drill, maybe it ought to be build baby build, Villa wrote. Unfortunately, it's not as simple as that. Danushka Nanakara Skillington, the National Association of Home Builders Assistant Vice President of Forecasting and Analysis, said that while the Fed's recent half-point rate cuts will increase the availability of loans for home builders, they are still faced with other strains, including a shortage of workers, the cost of regulations, zoning restrictions, and more expensive building materials. We still have 250,000 open jobs in the construction trade, she said. Earlier this year, that number was around 400,000 jobs. So it has come down as the job market has slowed down. There are a lot of factors that affected the housing supply, and these are complicated issues to solve. It can't be solved overnight. So if builders are still having issues building and home expenses are on the rise, it seems like we're back to interest rates having to save the day for ever increasing affordability crisis. At least with a smaller mortgage payment, money will be freed up to pay for these other expenses. And like I said at the beginning of this video, I think that interest rates have to be closer to 5%, maybe between 5 and 5.5%, to really unleash this lock-in effect and create more inventory. A senior economist at Wells Fargo estimates that the average 30-year fixed mortgage rate will fall to 5.5% by the end of 2025. We're not expecting mortgage rates to fall that much further, and we still think that the mortgage rate lock-in effect will still be there, Doherty said. Although it should ease up a little bit, meaning supply will come up a bit and maybe normalize. Moody's Analytics also believes that mortgage rates will fall to 5.5% by the end of 2025. I expect the 30-year fixed mortgage rate will be closing in on 6% by the end of the year and settle in near 5.5% by the end of 2025. The expected decline in mortgage rates is due to a narrowing in the spread with the 10-year Treasury yield as the Fed eases policy. The yield curve becomes normally sloped and bond volatility declines and prepayment risk normalizes. Moody's chief economist Mark Zandi tells Resi Club. The Mortgage Bankers Association expects interest rates to fall to 5.9% by the end of 2025 and will continue to average 5.9% into 2026. Fannie Mae expects interest rates to be at 6% by the end of this year and 5.7% by the end of 2025. And Wells Fargo expects interest rates to fall to 5.95% by the end of 2024 and will continue to fall to 5.55% by the end of 2025. The chart was provided by Lance Lambert and Resi Club. As for home prices, Fed Chair Jerome Powell does remind us that even if lower interest rates frees up sellers to sell, they may also become buyers in the same market. As rates come down, people will start to move more, and that is probably beginning to happen already. But remember, when that happens, you've got a seller, but you've also got a new buyer in many cases. So it's not obvious how much additional demand that would make, Jerome Powell. He didn't actually say whether lower rates and more sales in the resale housing market would put upward or downward pressure on home prices. But he didn't rule it out. With the upcoming election, where both candidates are focusing on our housing crisis, which is a good thing, although they're approaching it in very different ways, I think the next few months will be really interesting. But what do you guys think? What do you think is going to happen in our housing market? As we all know, real estate is very localized to what's happening where you live. Put it in the comments and tell us what you see. Let's end with some of the latest data from Redfin's latest housing market update. New listings are up 5.1% from a year ago, and active listings are up 16.1% from a year ago. But it's the smallest increase since April. 34.4% of the homes still sold in the first 2 weeks, down from 38% a year ago. The median days on the market is 37 days, up 6 days from a year ago. And the share of homes that sold above the list price is 27.5%, down from 32% a year ago. And the months of supply is 3.9 months, which is up 0.8 points from a year ago. Just to give you context, they say 4 to 5 months of supply is a balanced market. If you missed the video where we discussed Vice President Harris's plans for our housing market and we found some flaws in it, definitely check that out next. Thanks for watching. I do appreciate it. Bye!